Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about, is it a good time to be buying stocks or investments in your portfolio? Everybody knows what's going on here most recently in 2020. We hit an all-time high early on, and then just as quickly as we hit that high, the bottom fell out, and for the first time since 2008, people are seeing a bear market. And what's going on right now is, we have a lot of clients and people that we're talking to. They're asking, okay, what is the best way for us to get out of this market bottom? Is there anything we can do other than just waiting for the market to recover? And to a certain degree, yes, you can help yourself out. Tyler and I discussed with our clients, there's really three phases to helping your recovery. The first phase is to build that cash up when the market is well, which we typically do with all clients, and that is take some of the gains off the table and create some cash in their portfolio so you can buy at a time like this. So early on, we did that, as well as the bond market was relatively stable when we first got into this volatility. And then all of a sudden, when interest rates went down to zero, you saw the bond market become very unstable. So while gains were still available there, we did liquidate bond positions. So you've got a big pool of cash from gains previous year and earlier this year. And then you have bond positions. So you wait it out, you look at the investments, and you tend to try to see if bottom is near. We're not timing the market, but you can see that the market went down anywhere from 20 to 34% at any particular time in 2020 through March. And once the market starts getting towards the bottom, you look at the second phase of your potential recovery, which is a buy-in. And that's what we're going to talk about now. And the third phase is really just analyzing your moves to see if it needs to be done again. But today we're going to talk about mainly, is it time to buy in? And there are reasons to buy in, and there are reasons not to buy in. And not every stock is created equal when you buy in. You're going to find out that there are reasons that some stocks are down 30, 40, 50%. Does that make them a good buy opportunity? Not necessarily. There are also opportunities where you have momentum stock, such as Clorox, that is doing very well in 2020. And people say, well, shouldn't we be moving all towards that? We don't know. That could be at an all-time high right now, and you miss some of the growth opportunities. So we're going to talk about some of these things. Tyler, let's just look at a global view right now. Is it a good time to buy stocks?
Yeah, Dean. So this has often been a question that we've gotten lately. Different people wondering, is now a good time to buy? And as we head into early April here, we do see volatility easing up a little bit from the major swings that we've seen in March. Now, don't get me wrong, it still is volatile. The market still is volatile right now in early April as we're in the midst of this whole virus pandemic. But at the same time, we haven't been seeing the major swings that we saw just a few weeks back. So for example, in March, there were a few days where the market was down 10%, up 11%, down 12%. So, and that's in one day. Obviously, we've never really seen a consistent pattern of moves that way where it's so volatile. However, now into early April, as I said, volatility is easing up a little bit here. So that is one reason, and we'll get into the reasons a little bit later on in the show here, more in depth. But that's one reason where some people might want to buy just when they see the wild swings settling down a little bit. However, even with the volatility settling down, the stock market indexes are still down about 20 to 30% since the start of the year. So that's the NASDAQ, the Dow Jones, the S&P 500. They're down in that range of 20 to 30% since the start of the year. And that's even after rebounding slightly a couple weeks ago. So no matter how you look at it, the market is still at a 20 to 30% discount from the beginning of 2020. Now, that's the overall stock market. When I say the market is down 20 to 30%, that's the overall market. But we still do have some individual stocks, mutual funds, ETFs that are either down more than that or up more than that. So, for example, Dean, like you had mentioned, you've got Clorox, even some stocks like Amazon, which are actually up since the beginning of the year. But then you have stocks in certain sectors and industries like oil, the cruise lines, the airlines that are down upwards of 70 or 80% since the beginning of the year. So really, the overall market is still down about 20 to 30%, which it could provide a relatively low entry point, even if we're not at the very bottom. And that's something else that we're going to discuss, because we're not advocates of trying to time the market in general, especially not trying to time the market bottom. But instead, there could be opportunities to invest smaller amounts at regular intervals over time. And that's something that we're going to get into as well. But ultimately, whether or not it's a good time to buy right now, buying into the market at this point, it really depends on a number of different factors that apply to your own personal situation, your investment timeline being one of the main ones, and your risk tolerance in such a volatile market. And we'll go and lay out the different reasons for each in terms of why it might be a good reason to buy in or why it might not be a good reason to buy in.
Okay, the first thing we're going to talk about is the reasons to buy in right now. And in our office here, we've been talking about this for a couple of weeks, and that is, it looks like there's selling fatigue happening out there. And what we mean by that is, it looks like a lot of the large sellers got it out of their system here. The coronavirus has really put a damper on buying opportunities up until most recently. So people sold pretty extensively. Also, there are a lot of hedge funds and institutional investors that quite honestly don't make money when their clients are in cash, and they've been carrying cash for quite some time after they sold off. So you're going to see those people or those companies buying back in, not all at once, but they are going to create some volume buying back in. And then also pension funds. Pension funds, those people who have pensions, those funds are typically backed with investments, and many times it's stock investments. And many pension funds are now starting to buy towards the bottom here. So you are seeing some momentum. However, the stock market hasn't responded 100% favorably to all of the financial stimulus opportunities. The financial market didn't really continue its growth after interest rates went down to zero. Once the $2.2 trillion stimulus plan was put in place, there was a bounce for a while, but then it has come back down. It really comes down to, we think that until there is some good news or until the peaking of the coronavirus, we're going to still see, volatility. As Tyler said, the volatility waned a little bit as far as 1,000-point swings every 2 days, but we're still seeing, towards the bottom of the trough versus the top of the trough. But really, selling fatigue seems to be the one thing. Tyler, what else when it comes to selling fatigue?
Yeah, Dean. So one of the reasons that people might want to consider buying in right now is something called selling fatigue, and that's a term that's not mentioned too often, and it hasn't been mentioned too often because we haven't seen a lot of selling fatigue for over 12 years now, going back to 2008. But what selling fatigue is that many market analysts and strategists, they've recently said that we're seeing that term selling fatigue, and that's where investors are no longer overreacting to bad news like they were a month ago or so. And that's where, again, like I mentioned earlier, days where the Dow Jones was down as far as 12%, 10%, up 11% in a single day, then down 6 and 7% in days after that. And we also seen something called circuit breakers, where if the market goes down a certain amount, they stop and halt trading for 15 minutes. That happened 3 different times within 2 weeks. So that right there just shows how the extreme volatility really played a role in the market over the last month. But again, selling fatigue is where there's bad news that's coming out based on the virus, based on unemployment numbers, based on the economic shutdown that we're having right now, and the physical shutdown of businesses as well. So that bad news a month ago, people were reacting to it very severely, even overreacting, where now they're no longer overreacting. Now it's almost been priced into the market where It's sort of sad to say that we're used to it, but lately that's what it's been. When you have a shutdown like this, where you shut down the economy, there's unemployment going on. People are no longer they're no longer overreacting to the bad news like they were a month ago. So really, selling fatigue, what it comes down to is if we don't see that overreactions or that overreacting anymore, then that's going to lead to at least a little bit more stability. And again, there's still volatility in the market, but not nearly as much as there was a month ago. Obviously, that can change moving forward, but right now we're seeing slightly more stability during this little bit of a market dip that we had here. So again, a reason might be selling fatigue, where we might not see as much volatility. There's a little bit more stability than there was a few weeks to a month ago. So that's one of the reasons not to buy in right now, or reasons to buy in right now. And one of the other ones would be looking at good companies at cheap prices. So with the recent market downturn, there's pockets of the stock market that offer very good value. And now this is where you don't want to get confused, because quality companies such as Apple, for example, are down anywhere from 15 to 25%. So buying into some quality companies like Apple down right around 20% at lower prices, that could present a really good buying opportunity if you expect that particular stock or company to rebound nicely once this economic shutdown and the virus peaks and when things start to get back to normal again. So really it gives you good opportunities to look for companies that are good quality companies. They have good balance sheets and they're beaten down right now.
Okay, and as Tyler said, as you picked up there, he said good companies. We like to still buy momentum investments, and that is even in this volatile market that we have right now, early 2020. As Tyler said earlier, there are companies like Amazon, there are companies like Microsoft, there are companies like Adobe, Apple, that are not down nearly as much, and they're still maintaining momentum. They had positive momentum prior to the coronavirus. They have momentum now. So many times you look at those and say, could that be a better buy than if you were bottom fishing or bottom feeding? And what we mean by that is some people absolutely want to go in and buy the worst beaten down stock. However, you have to remember there's many times reasons why they were beaten down more so than some of the other sectors. Again, Tyler brought up airlines and oil. Okay, they're affected, in ways not just because of the coronavirus sell-off. Oil, you have Russia and the Saudis not playing nice together and manipulating prices. The cruise lines too. When everything is going very well in our economy, they're going to prosper. But other than that, they could languish for some time. And you also have to remember too, and this isn't, you have to take this seriously, and that is look at the financials. As Tyler said, you need to look at the financials. We want to see companies that do have cash positions, just like people are, we're Dave Ramsey proponents, and we tell people you should have up to 6 months of cash to take care of debt or expenses if you lose your job. Well, here's an example. These companies should abide by the same thing in a different manner, and that is they need to have cash positions built up for liquidity to weather the storm. If you're strictly bottom fishing or bottom feeding, taking those stocks that are hit the worst, some of those companies could go out of business. So, you have to take that into consideration. You're typically better off with large cap U.S. investments. We just saw this week, some, Chinese stocks were accused of improprieties where they, their books are false. They're smaller companies. You need to look at large cap companies, look at their financials, look at the momentum. Don't just bottom feed.
Yeah, very good point, Dean. And this is a conversation that I've had with some people more frequently than I would have liked lately. But we feel that it's very important to buy into companies that have good prospects for a rebound during this downturn here. So, for example, companies that are in industries like consumer staples. So, obviously, you hear all the stories about people and getting their toilet paper. People still are going to need toothbrush, toothpaste, food. So, consumer staples, technology, and healthcare. Obviously, there's so many different healthcare companies trying to come up with a vaccine and different treatments for the virus. And then technology is something that could potentially rebound just because we're moving to more of a stay-at-home economy during this whole quarantine. that those certain sectors, consumer staples, technology, healthcare, have much higher of a chance for rebounding and recovering much quicker than stocks that are in sectors that are extremely beaten down just because you're buying low. So for example, oil, airlines, and cruise lines, they might be lower. You're buying in lower into those stocks than you would a company like Apple or Microsoft or Amazon or Walmart. But even though you're buying in lower, the recovery could be that much longer just because people aren't going to they're not going to rush to a plane. They're not going to rush to cruise lines after this pandemic. It's going to take a little bit of time for that to rebound. So you might be better off buying into something that's down 20% as opposed to 50% if it can recover that much quicker, and if it's in an industry or sector that has more growth potential over the next 3, 5, 10, 20 years. So that's one thing to keep in mind. Now might be a good reason to buy in good companies at cheap prices. Just make sure that you pay attention to the industry. You want it to be in one that is going to recover and it has good long-term growth prospects.
Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Packerland Drive in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srs.com.
Okay, the next one we're going to talk about as far as a reason to buy is even if you don't time the bottom exactly right, it's still a great opportunity to buy. We see this all the time. People saying, geez, I wish I would have bought in yesterday because, the market was down 3% and today it's up 2%. Don't get caught up with single days or weeks. What we need to look at are months and years. Just understand whether you miss the bottom, you still buy low. Buy when the market is down and you anticipate that the market is going to be in a recovery mode relatively soon. We tend to believe so. We tend to think that we're going to see some significant volatility until the coronavirus peaks and all of these unemployment numbers are out there. And we're going to start seeing sales numbers coming in from companies that aren't all that impressive. Okay, that will take care of itself. We tend to think that it's going to be a bumpy ride through the second quarter yet, through the middle of summer. And we're hoping, as everybody is, that the third quarter and fourth quarter this year are going to look like substantial recoveries. Part of the reason we think that is that the market was doing very well. The economy was doing very well before the pandemic started. People say, well, this is another 2008. We don't agree with that. And part of the reason is if you look at 2008, economically and the market itself were very stale, or there were problems on the horizon already. Now, that doesn't mean that we couldn't go into a prolonged recession. We'll see how it plays out. But at this point, the stimulus money was done in weeks since it was first announced. In 2008, it was done in months. It took months to get stimulus into the market. And it wasn't even nearly the amount that they're putting into the market right now. It's actually scary, the amount that they're putting into the market right now. So anyhow, don't try to time the bottom, but dollar cost average, start buying in when the market is low. Don't get caught up with whether it's down 30% today and it's now down to 28% and I shouldn't buy in. No, as long as you're buying substantially lower than what the market was, that is a good trend. Do not buy in all at once. Okay, Tyler and I, dollar cost average, buying in. We'll buy a little today. We'll buy a little bit next week. We'll buy a little bit as long as we're buying in while it's low. And we do think that we've hit relatively close to the bottom.
Yeah, Dean, really good point there. The main takeaway here is even if you don't time the market bottom exactly right, with which chances are likely you won't, you're still going to buy in low. So trying to time the market bottom during a dip, it's extremely difficult. It's basically like playing the lottery because you just don't know, especially in times like these. And right now, even if stocks might not have bottomed out yet, we had a nice little rebound over the last week and a half, but we could go back and set new lows. Who knows? No one knows. You usually shouldn't try and wait and time the exact bottom because it's notoriously difficult. And the one thing that people don't realize is it could come at the expense of significant returns, where the market could bottom and then it could go back 10% in the matter of 2 days. and now you're stuck waiting, and you think, okay, is it going to bottom out? Is it going to go back down again? Maybe I should wait, and then it goes back up and recovers for good, and you just missed out on a big portion of gain where you should have been just simply dollar cost averaging in, putting a little bit in week to week and month to month, as opposed to trying to time it exactly and buy in with a big chunk at the exact bottom, because again, it's almost impossible to know exactly when the bottom is. So instead, the main takeaway here is that we advocate slowly buying in instead of trying to time the bottom, because again, even if you're not timing the exact bottom, you're still buying in at low prices. You're still buying in at a deep discount where you can look back a couple years from now and say, okay, even though I didn't buy in at the exact bottom, I bought in right around the bottom, and that still allowed for a really good recovery potential and really good long-term growth by buying in right around the bottom. So again, don't try and time the exact bottom. Still buy in low periodically, trickle a little bit into the market around the bottom.
Okay, good points, Tyler. Next one we're going to talk about is another reason for buying in now is you're going to be able to buy more shares when the market drops. This is something that I like a lot. If you take a good company, a company that just 2 months ago you considered a wonderful company, a wonderful stock in your portfolio, typically it didn't become a bad stock or a bad company because of what's going on with volatility in the market. Systemic volatility brings everything down. You cannot if you're in the market, you're not going to be contrary to which way the market is going. If the market is going down, accept the fact that your portfolio will probably go down. You hear other people out there talk about how they can make significant money in the market when it's down. Yeah, you can, but they're probably gambling a little bit more than what we would advocate for our clients. We're investment advisors, not traders. We do trading in portfolios to do two things, and that is to protect from a loss and to pick up a gain. It really comes down to those two things. But when it comes down to getting more shares when the market drops, that's a wonderful opportunity, especially if you're looking at great companies. Good companies at a low, I mean, that's got Warren Buffett written all over it. Warren Buffett, I mean, his claim to fame has been basically rescuing certain companies, especially in 2008 when they had no liquidity and they were on the bottom, but they've shown significant momentum prior to that time period. Well, look at yourself in that same fashion. Again, don't necessarily bottom feed on oil and airlines at this point. Look at some momentum, but you're going to be getting significantly more shares when the market is down, which is what you want to do.
Yeah, Dean, good point there. This one is mainly for people who have you're investing in your mutual funds within your 401k, or you might have mutual funds, ETFs, and stocks within a Roth IRA. But when the market goes down, it can actually be your long-term friend if you contribute regularly. If you dollar cost average, meaning that you buy in every paycheck or every month with the same dollar amount, you're going to be buying more shares because share prices are lower from the market being down. So even though buying into different investments that are falling in prices can be frustrating, it's important to keep in mind that buying more shares at lower prices puts you in a much stronger position to recover once prices start to rise again. So especially if you have a long-term time horizon, like in your retirement accounts, your 401k, your Roth IRA, your regular IRAs, then this strategy can actually benefit you when the stock market is beat up, where you're simply dollar cost averaging. We talked about this a little bit before, but again, the same thing applies with your 401k and Roth IRA. Now is not a time to stop contributing. Now is actually when you want to continue to contribute because you're buying more shares when the market is lower. That will put you in a much stronger position to rebound and recover once the market comes back up again.
Okay, we're gonna before we close, we're gonna talk about a couple of reasons maybe not to buy investments right now in your portfolio. If you're flush with cash that was created when the market was good, it gives you an opportunity to wait until the market starts to recover a little bit and you see momentum on the backside. That's a good opportunity. Also, the coronavirus, it's a pandemic that none of us have been through before. This is new to everybody. We have no idea what the final outcome is going to be. With that many questionable things, if you feel more comfortable sitting on the sideline until, again, we see more significant growth coming out of the hole. Some people want to time the bottom. They want to be down there buying when the market was down 30%. The Dow was down over 30%. Some people do not like that feeling because it's too bumpy down there. They want to start buying when maybe we had a 15% or even a 20% recovery, but we're still down 10%. That's fine. Just understand that over the long term, if you look at the stock market since the 1930s until most recently, at every 10-year increment, you typically are going to be more favorable than unfavorable. You'll see more gains than losses. So we just, you need to feel comfortable with your timeline, talk to your advisor and see if they believe it's a good time to be buying back in. What else, Tyler?
Yeah, Dean, just the main thing potentially not to buy stocks right now for people who might want to hold off is just some people do think there are too many unknowns. When do coronavirus cases start to decrease? When is there a vaccine? When does the economic activity start to open back up? So that alone, it might not be a little while yet, meaning that there could be more of a downturn left in the market yet before we hit a new bottom, and also not enough stability. Some people, they want to see more stability. They don't like the wild, volatile swings in both directions, but ultimately, it all depends on your time horizon and risk tolerance. For those people who are younger, I see no problem going and, like we said, slowly trickling money into the market, dollar cost averaging. Don't put everything in all at once, but slowly buy on the down days. For people who have a longer time horizon, I think that's a really good strategy. For those people who are near retirement and have some cash on the side that they might want to put to work, you might want to, if you have a higher risk tolerance, you can definitely go ahead and do that. Or you might want to wait till we see a little bit more stability in the market. So really, it all depends on what your investment timeline is and your risk tolerance.
Okay, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them on Packerland Drive in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.